Imagine a prosperous country like New Zealand's entire annual economic output vanishing overnight. That's what happened to UnitedHealth Group, or UNH, which lost over $100 billion in market value in a flash. This wasn't a minor dip, it was a seismic event, erasing wealth on the scale of a developed nation's GDP. UnitedHealth isn't a risky startup, it's a blue-chip giant, a pillar of American healthcare and a Wall Street favorite. For years, its stock only seemed to go up, making this sudden crash all the more shocking. The loss sent shockwaves through the Dow Jones, dragging down the broader market and impacting pension funds, mutual funds, and retirement accounts everywhere. Financial news networks scrambled to explain how such a titan could stumble so badly. The lesson? No company is invincible, and panic can create rare opportunities for savvy investors. The key question that Buffett asked, is this a sign of deep, permanent trouble, or just a temporary setback? Is the market overreacting, or is there real cause for concern? To answer that, we need to look past the headlines and dig into the heart of the business. Let's find out what really happened to UnitedHealth and what Buffett saw. UnitedHealth's troubles didn't start with a single event, but a cascade of bad news. First, the company reported rising medical costs. Its medical loss ratio spiked, signaling shrinking profits. Then, the Department of Justice launched an antitrust investigation, targeting the relationship between UnitedHealthcare and Optum. Regulators worry that UnitedHealth's size and integration might stifle competition and harm consumers. The threat of a government crackdown introduced massive uncertainty. To make matters worse, the long-serving CEO stepped down right in the middle of this turmoil, leaving investors uneasy about new leadership. All this unfolded as seniors returned to hospitals post-pandemic, driving up medical claims industry-wide. For UnitedHealth, the nation's largest Medicare Advantage provider, this was especially painful. Rising costs, a DOJ probe, and a leadership shakeup created a perfect storm. The result: panic selling and a full-blown stock market crash. Investors were left wondering if this was a temporary storm or the start of a long decline. The convergence of these factors shattered confidence. But is the damage permanent? The market's reaction was swift and brutal. UnitedHealth's stock plummeted, slicing through key support levels. It crashed below its 50-day, 100-day, and even the critical 200-day moving averages. Technical analysts saw a death cross, a bearish signal that triggered even more selling. Trading volume exploded, showing that both big and small investors were rushing for the exits. Panic selling took over, pushing the price well below rational estimates of value. Eventually, the stock found a temporary bottom, but the long-term uptrend was broken. The charts told a clear story. A blue-chip champion had been knocked down hard. The question now, was this a knockout blow, or just a stumble? For investors, the technical damage was real, but so was the potential for a rebound. The next move would depend on the company's fundamentals. When a great company's stock crashes, value investors like Warren Buffett pay attention. They ask, do I understand the business? Does it have a durable moat? Is management strong? And is the price right? UnitedHealth's business is straightforward. It insures millions and runs a vast healthcare services arm, Optum. Its scale gives it immense bargaining power and a unique integrated model that's tough to replicate. Optum's data and services feed the insurance side, creating a powerful feedback loop. The recent CEO change is a concern, but the company has deep executive talent. The real question, has the stock fallen enough to offer a margin of safety? Valuation multiples have dropped well below historical averages. For value investors, this is where things get interesting. If the price has fallen more than the business's true value, it could be a rare buying opportunity. But only if the fundamentals remain strong. The challenge is separating temporary fear from lasting damage. Let's look under the hood. Before buying a fallen stock, you need to check its financial health. UnitedHealth is a financial powerhouse, generating nearly $400 billion in annual revenue. Even with recent headwinds, its earnings per share have grown steadily for a decade. Rising medical costs have squeezed margins, but the company still produces tens of billions in net income. Free cash flow is massive, funding dividends, buybacks, and acquisitions. UnitedHealth has a strong record of raising its dividend, signaling management's confidence. The recent price drop has made the dividend yield more attractive for income investors. Debt is significant but manageable given the company's size and cash flow. Its interest coverage ratio remains healthy, providing flexibility in tough times. A strong balance sheet is crucial when facing uncertainty. Overall, the numbers show a robust enterprise, not a company on the brink. But financial strength alone isn't enough. Industry position matters too. So how unique is UnitedHealth? UnitedHealth isn't just another insurer, it's woven into the fabric of American healthcare. It's the largest health insurer, a dominant Medicare Advantage player, and a major Medicaid administrator. Its insurance arm touches 1 in 6 or 7 Americans. What sets it apart is Optum, a vast empire of pharmacy benefits, clinics, and data analytics. This vertical integration creates a powerful feedback loop. Insurance data informs care, and care delivery controls costs. Few competitors can match this scale or integration. UnitedHealth is almost like a utility, critical infrastructure for the healthcare system. Breaking it up would be complex and disruptive, making drastic regulatory action less likely. Its indispensability is a key part of the investment thesis. The company's deep integration and scale create a moat that's hard to breach. But what is all this really worth? To estimate UnitedHealth's true value, investors often use a discounted cash flow, or DCF, analysis. Assume cash flows grow at 8% for the next decade, then slow to 3%, a conservative estimate. Discount those future cash flows at 10% to account for risk and the time value of money. This calculation might suggest a fair value of $550 per share. If the stock trades at $270, it's about 51% undervalued. Value investors want a margin of safety, maybe only buying if the price drops to $410 or below. This buffer protects against errors or surprises. The key: buy only when the price is well below intrinsic value. But valuation is just one side of the story. What about the risks? Every investment has a bull and a bear case. The bear case, regulatory risk, is huge. The DOJ probe could force a breakup or restrict UnitedHealth's integrated model, destroying its main advantage. Rising medical costs may not be temporary. If the company can't raise premiums fast enough, margins could stay under pressure. The bull case: these problems are temporary, and the market has overreacted. Management has a track record of adapting to cost trends and regulatory changes. The company's scale, integration, and role in healthcare remain unmatched. Bulls see the current price as a rare chance to buy a dominant franchise at a discount. If the storm passes, today's panic could look like a blip in a long-term upward trend. The outcome depends on whether the company's strengths can outlast its current challenges. Which side are you on? To understand UnitedHealth's edge, compare it to rivals like Elevance Health, Cigna, and CVS Health. Elevance is a massive insurer but lacks Optum's deep integration. Cigna has a strong pharmacy benefit manager, but its scale and network lag behind. CVS combines insurance, pharmacy, and retail clinics but doesn't match Optum's breadth in data and care delivery. Each competitor excels in a niche, but none have UnitedHealth's all-encompassing ecosystem. This unique structure is why the DOJ is so focused on UnitedHealth. It's the only company with this level of integration. For investors, this means buying more than just an insurer. You're buying a healthcare ecosystem. UnitedHealth's model is tough to replicate, giving it a lasting advantage, but that advantage is also what regulators are scrutinizing. The stakes couldn't be higher. Let's revisit the value investor's checklist. Is the business understandable? Yes, insurance and healthcare services, not a black box. Does it have a durable moat? Absolutely. Scale, brand, and unique integration. Is management strong? The CEO change is a concern, but the company's track record is solid. Is the price attractive? The crash has pushed valuation to multi-year lows. For those who believe in the company's long-term power, this is a classic value setup. The risk is real, but so is the potential reward. The opportunity is there for those willing to look past the fear. In the end, every investor must decide for themselves. UnitedHealth's crash is a lesson in market psychology. Fear can bring down even the strongest companies. The headlines scream crisis, but the fundamentals tell a more nuanced story. The intelligent investor looks past the panic, focusing on long-term business performance. UnitedHealth remains a dominant, cash-generating force in a critical industry. The stock price has been punished more than the likely long-term impact justifies. The real question: will the current storm pass, or is this the start of a decline? Your answer depends on your research, risk tolerance, and time horizon. Do you see a warning sign or a rare buying opportunity? There's no single right answer, just the discipline to ask the right questions. Stay curious, do your homework, and remember, fortunes are made by seeing a crash as a chance. The choice is yours. If you like analysis like this, like and subscribe to 7 Hills Equities for more in-depth evaluations.